Hello traders. Hey, today I wanted to take just a few minutes to introduce us to a technical study that was just introduced in 2023. One of the newest chart studies out there. It's known as the Stochastic Distance Oscillator, introduced by Vitaly Apparini in 2023 and used by some traders to potentially identify short-term highs and lows that have reached kind of extremes. That's what it was designed for. Let's go right to it and discuss how this is built and how it might be used to generate trade signals. Now, the very first thing that we need to do is consider the risks associated with trading. Just bear this important information in mind. This material is intended for general informational and educational purposes only. Schwab does not recommend the use of technical analysis as a sole means of investment research, and investing involves risks, including the loss of principal. Now, with that said, let's go right to a chart and get acquainted with what's known as the Stochastic Distance Oscillator. So here we are on the Thinkorswim desktop paper money platform. And I'm going to go up here and click on the little flask icon for Edit Studies. And let's type in the word stochastic to work our way through that menu of hundreds of technical indicators that might be added to our charts. We're going to choose the Stochastic Distance Oscillator and add that to our chart. But before we apply that, I do want to note that we're getting some important insight into the internal mechanisms of this indicator right here. We'll revisit that in just a moment, but I want to apply this to our chart and click OK. And what you'll notice here is that we're left with an oscillating line that goes into what we call an overbought condition above a value of 40. It also reaches an oversold condition below a value of 40. And what Vitaly had designed this indicator to do was hopefully identify short-term cyclical peaks hitting highs or lows. Now, a lot of traders operate under the assumption that stocks will tend to move in a sort of stair-stepping pattern. Rise and then fall on their way up or down. And very commonly, this will be distributed across approximately, roughly speaking, about a month's worth of trading. So let's show how Vitaly created this indicator, and then we'll look at potential entry signals and exit signals. So going back up here to our flask icon, I can click on the little gear icon, which allows us to see the internal mechanisms of this tool. And the first thing that we'll see is what's called the momentum length. This is really just the length of the indicator. And what this does is it looks back over the last 12 days and checks the range of prices for those 12 days. And then it compares those against the average range of prices for every 12-day period for the last 100 days. So why 12 days? Well, that's about half a month in trading days. Why 100 days? That's about half a year in trading days. So if we were to assume a short-term cycle is about a month and a longer-term cycle is about a year, we're looking at going from peak to trough or from trough to peak over those short-term and longer-term time frames. Now, within this indicator, if we're just looking at 12 days worth of data, that can cause the indicator to change pretty violently around on the chart. So Vitaly also introduced a smoothing mechanism. He applies a 6-day exponential moving average to this average price over time, and that gives us this sort of smoother presentation on our stochastic oscillator. And then finally, using his own algorithm, he generates what he calls an overbought and oversold range. Now, if you want to see more about how this is built, this is publicly available data. You can go Google it. It's quite an involved indicator. I don't want to go further into it than that, because I want to get into how it might generate buy and sell signals for the trader. So let's go ahead, click OK here, get back to our stochastic distance oscillator. So conceptually, what the trader is looking for is when our SDO line has reached all the way down into an extreme, quote unquote extreme. This is according to Mr. Apparini's definition, but this is something that doesn't happen very often. Maybe 2 to 4 times per year, we'll see this SDO line dive down below a value of -40. And there are 2 potential entries from this point. This may be signaling that price seems to be reaching near-term, short-term cyclical lows. The first signal might be if our SDO line turns and starts to rise again, as it did right here. And that seems to have generated an entry signal about right there. Now, other traders may wait for the SDO line to cross back up above that overbought territory line right about here. Now, what that will do is it will generate later signals, but the hope with this sort of a more patient approach is that it will eliminate whipsaw signals, or it might assist the trader in avoiding some of those scenarios where the SDO line goes down and remains below minus 40 for a while. Maybe stock prices struggle for a more extended period than anticipated. But those are two typical entry signals. And you can see there are other examples here. There was an example here. And more recently, right here and right here are two recent below 40, but below minus 40, but rising signals. So if those are entries, when might the trader take their profits if profits manifest themselves? Well, the two potential exits. The first is determined by the indicator itself, and that is just waiting for our SDO line to get above the get into the overbought range, and then to start turning down as it did right here. That would have given us an exit signal about right there. Or there was another example right about, looks like about right there, and that may have generated an exit signal somewhere in here. But that's using the indicator itself. Sometimes the trader, though, just uses price. So with each of these signals, with each of these entry signals, because it's generated by price itself, when the SDO line has been coming down, price will have been coming down on average before that. And so the trader might just look to recent highs. So an example here might be an entry signal here, looking to the recent high just before that, and then exiting if price gets back up to that high. In this case, it looks like it took a little while, but eventually got there. Here's another example where we rose back up to a previous high right in this area. Now both of those are examples of how trades that might be managed if they turn out well. But certainly this indicator, like pretty much every other indicator, is not perfect, may fail. So a typical exit if the signal is invalidated, if it's failing, is to just exit on a penetration of recent lows. So how about we take this one as an example? And you can see the lowest price right before that signal was generated was right on this candle low. So maybe exiting $1 or a percentage point or two below that may be a stop management or risk management technique. Now, even if we place a stop order there, of course, it's not a guarantee that we will sell at a specific price. But guys, there's your quick introduction to the stochastic distance oscillator. And this is the sort of thing that I do and explore in my weekly webcast series known as the Advanced Charting Techniques webcast series. So do yourself a favor. If this is your first exposure to Schwab education, make sure that you have subscribed to our Trader Talks channel on YouTube. Trader Talks Schwab Coaching Webcast is the name of the channel. You can join live streams on that channel, but you can also find playlists of previous webcasts, including one that I did just last Friday, where I spent 45 minutes exploring the stochastic distance oscillator. So let me click on that playlist link. And if we scroll down, about halfway down through all of these webcast series is my Advanced Charting Techniques series. And if I click on that View Full Playlist, you'll see there was our discussion. For those that have never traded the stochastic distance oscillator, you're not alone. It's only been around for a few years. All right, one more suggestion I have for you, and that is to follow me on social media. You can find me on X, you can find me on LinkedIn. My handle on both is Cameron May CS. So if you go to X, it's at Cameron May CS, and I post commonly here. And if you reply to one of my posts, I just try to reply right back to you. Or you can flash over to linkedin.com/in, and then Cameron May CS again. That'll take you to my profile. Give me a follow. If you reply with a comment on one of my posts, I just try to reply right back. And it opens those channels of communication when I'm not on camera. Everybody, hopefully this was a great introduction to you for the stochastic distance oscillator. I'll look for other studies and techniques to introduce to you in future videos. But between now and then, I'll look for you on webcasts. I'll look for you on social media. And whenever I see you again, until that moment arrives, I want to wish you the very best of luck. Happy trading. Bye-bye.